Last week, a single headline from China erased tens of billions of dollars from ASML's market value. The trigger wasn't weaker earnings. It wasn't lower guidance. And it wasn't the loss of a major customer. Instead, reports emerged that China had begun producing its own advanced immersion DUV lithography machines, technology that has long been dominated by foreign suppliers. Almost immediately, investors began to reassess one of the market's strongest assumptions. What if ASML's technological monopoly is no longer untouchable? The market reacted before there was clear evidence that China's new system could match ASML's most advanced capabilities. And that's what makes this story so fascinating. Because history shows that financial markets don't just price today's facts. They price tomorrow's expectations. So in this video, we're not asking whether China has built a lithography machine. We're asking something far more important. Did Wall Street correctly identify the beginning of a structural shift in the semiconductor industry? Or did investors simply price fear faster than they priced the facts? To understand Wall Street's reaction, we first need to understand what the market was actually pricing. Investors weren't reacting to a single machine. They were reacting to the possibility that one of the strongest competitive moats in the semiconductor industry could eventually be challenged. For years, ASML has occupied a unique position in the global chip supply chain. The company is the only commercial supplier of extreme ultraviolet, or EUV, lithography systems, the machines required to manufacture the world's most advanced chips. That technological leadership has allowed ASML to become an indispensable partner for companies such as TSMC, Samsung, and Intel. So when reports suggested that China had made a significant breakthrough in lithography, investors immediately began asking a different question. If China can eventually build its own lithography ecosystem, could ASML's long-term competitive advantage become less certain? And in financial markets, uncertainty is often enough to move prices long before the fundamentals actually change. So, let's begin with the facts. The market reaction was triggered by reports that China had started producing its first domestically developed immersion DUV lithography machines. According to multiple industry reports, these systems are expected to be supplied to several of China's leading semiconductor manufacturers as part of the country's long-term effort to reduce its dependence on foreign technology. That immediately reignited a narrative investors have been debating for years. Could China eventually replace one of ASML's most important businesses? On the surface, the market's reaction seems reasonable. If a new competitor enters a market dominated by a single company, investors naturally begin to question the durability of that company's competitive advantage. But before reaching that conclusion, there's one critical question we need to answer. What exactly did China build? Because in the semiconductor industry, not all lithography machines are created equal. Here's where the story becomes much more nuanced. The reports from China refer to immersion DUV lithography systems, a significant technological achievement and an important milestone for China's semiconductor industry. But investors need to understand that immersion DUV and EUV are designed for different manufacturing requirements. Today's most advanced AI processors and leading-edge chips are manufactured using EUV lithography, an area where ASML remains the only commercial supplier in the world. That doesn't diminish China's progress. It simply means that the headline and the market reaction are not necessarily describing the same reality. In other words, the market wasn't reacting to what China has already achieved. It was reacting to what investors believe China could eventually achieve. And that distinction is critical. Because in financial markets, expectations often move much faster than technology itself. At this point, we need to separate two very different questions. Can China build a lithography machine? Based on recent developments, the answer appears to be yes. But that's not the question investors should be asking. The real question is this. Can China replicate ASML's competitive advantage? Because ASML's moat has never been defined by a single machine. It is built on decades of engineering experience, an installed base serving the world's leading chipmakers, long-term customer relationships, and an ecosystem of highly specialized suppliers that is extraordinarily difficult to reproduce. In other words, building a machine is one challenge. Replacing an entire ecosystem is a very different challenge. And that distinction may be where the market is making its biggest assumption. To determine whether Wall Street reacted appropriately, we need to look beyond the headline and examine the evidence. China's new immersion DUV system is undoubtedly an important milestone. It reflects years of investment and remarkable engineering progress. But according to industry analysts, it does not yet place China at the technological frontier occupied by ASML's EUV platform. More importantly, ASML's competitive advantage has never depended on selling the largest number of machines. It depends on supplying the only commercially available EUV systems used by leading-edge chip manufacturers. In other words, the market wasn't just questioning a product. It was questioning whether decades of technological leadership could be disrupted by a single breakthrough. That is a much bigger claim. And extraordinary claims require equally extraordinary evidence. This brings us to the most important question in this entire story. What exactly is Wall Street pricing when it values ASML? Is it simply the machines the company sells today? Or is it the expectation that ASML can remain the technology leader for the next decade? Investors don't assign a premium valuation to ASML because it manufactures lithography systems. They assign that premium because ASML has consistently stayed years ahead of its competitors in the technologies that matter most. That's why a single headline was enough to trigger such a sharp reaction. The market wasn't repricing today's earnings. It was reassessing the durability of ASML's future competitive advantage. And whenever investors begin to question the longevity of a company's moat, valuation multiples can change long before revenue or earnings do. That's exactly why this story deserves a closer look. To be fair, Wall Street isn't reacting without reason. China's semiconductor industry has made remarkable progress over the past decade. Massive government investment, export restrictions, and the determination to build a self-sufficient chip ecosystem have accelerated domestic innovation. History has shown that technological gaps can narrow much faster than many investors expect. So if Wall Street is beginning to price a future where China becomes less dependent on foreign lithography suppliers, that isn't an irrational assumption. It's a long-term scenario that deserves serious attention. But every investment thesis depends on one critical question. How soon could that future realistically arrive? Because in investing, being directionally right is not enough. Timing matters just as much. This brings us to the key issue. There is an important difference between a technological breakthrough and a commercial disruption. China's progress is real. No serious investor should ignore that. But the market's reaction suggests something much bigger. It suggests investors are beginning to price the possibility that ASML's long-term competitive advantage could eventually weaken. The question is whether today's evidence is strong enough to support that conclusion. At this point, China's immersion DUV systems represent meaningful technological progress. But ASML remains the only company capable of supplying EUV lithography systems required for the world's most advanced semiconductor manufacturing. That means the market isn't just reacting to what has changed today. It is also pricing what investors believe could change years from now. And when expectations move further ahead than verifiable evidence, markets can temporarily misprice risk. At this stage, the evidence suggests that Wall Street is pricing a long-term possibility rather than a confirmed shift in industry leadership. But investment theses should never be static. They must evolve as new evidence emerges. If China successfully develops commercially competitive EUV lithography, if leading-edge chip manufacturers begin adopting those systems at scale, or if ASML starts losing its technological leadership in the most advanced nodes, then today's concerns would no longer be hypothetical. They would become fundamental. Until then, investors should distinguish between a future risk and a present reality. Because in investing, anticipating change is important. But confusing possibility with certainty can lead to costly decisions. So, did Wall Street overreact? Based on the evidence we've examined, the answer is more nuanced than a simple yes or no. China's progress in lithography is real. It represents an important milestone in the country's long-term effort to build an independent semiconductor industry. And over time, increased competition should never be dismissed. But today's market reaction appears to reflect something much larger than today's facts. Investors are no longer pricing what China has already achieved. They are pricing what China might eventually achieve. That distinction matters. Because markets don't wait for certainty. They discount the future. Sometimes they get it exactly right. And sometimes they move faster than the underlying fundamentals. For long-term investors, the key question isn't whether ASML will face more competition. It almost certainly will. The real question is whether that competition is strong enough, and close enough, to materially change ASML's competitive position today. At this stage, the evidence suggests that the answer remains uncertain. And when uncertainty becomes fear, markets can create opportunities just as easily as they create risks. That's why the most valuable asset for any investor isn't reacting first. It's separating headlines from fundamentals. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.